name is Anthony. I'm a native New Yorker, born and raised. By trade, I'm a pharmacist. I did for 22 years, 22 long years, and I've been involved with financial markets since 2009. I started as a buy and hold investor, got into swing trading, and then in 2019, I decided to make the transition to day trading. And I'm sure as many of you that are newer have experienced, it's not the easiest transition. And I was quite surprised how different it is. And, all right, let me go from there. Um, my trading edges, I trade levels, which is the main focus of this presentation. I do also trade ranges through the lens of the auction market process. And I do trade order flow, but I only do that on the ES, and I trade the SPY through the ES. Uh, some hobbies and interests of mine. I'm a former powerlifter, and that is a picture of me about 14 years ago. Um, Anything on the sand or on the water, I love beach, water, all that kind of stuff. I love road trips, going RVing. I do play the drums when I have a chance, and I'm your eternal nerd. I love learning things just to know new things. All people that know me call me the king of useless trivia. So uh, let's move on to what is Pac-Man. I'm going to start with the elevator pitch, and I believe that every good strategy you should be able to sum up in one or two sentences that can be easily understood by many people. So you enter the trade as price is trading into a valid horizontal level with sufficient energy, and I'll define energy in a little bit. The idea behind Pac-Man is that it takes advantage of. Sorry about that, I got many people. It takes advantage of many different market dynamics, some of which are the effect of the options market on the underlying equity, order flow dynamics, what I call smart money, motivations and tactics, retail trader behavior and psychology, technical analysis, algorithmic signatures and price, and the fact that there almost always will be a reaction at the level. That's the most important part of the strategy, is that if the level is chosen properly, you will have a reaction. We just do not know how much of a reaction there will be, and that's how the strategy, as you will see, is built out. It's designed to adapt to the current volatility of the stock that you're trading, which should maximize your risk and maximize your gains and minimize your risk if done properly. The idea that I came up with is that I want to try and place myself on the same side as the larger players, and at the same time capitalize on retail trader behavior and use it against them. I look for manipulation in the market. I look for where trapped inventory can be. And generally where retail puts stops, I look to enter. And when retail is chasing stocks up and to the moon and chasing stocks falling off a cliff, I'm looking for places to get in on the opposite side. Okay. This slide here is just showing the effect of option theta on the option. And what theta is, it's time decay. It's also called premium melt. So we have here NVIDIA, the equity, and this is the NVIDIA 135 calls. And you can see NVIDIA put in a nice double bottom right here, but the option actually made a lower low, this is very normal. It happens all the time. And this is what I'm taking advantage of in this strategy. I get my entry as low as possible, so when it pops up, I can take a bigger profit. The way I start my day every morning is with a top-down analysis. So I will start with the month, the week, the day, and I want to just see what the posture of the market is. So in this example here, this is the SPY. I would call the month up because we have a big white candle. I would call the week up to balance because it's up and now it's going sideways, which is balance. And the daily, because of this big red day we just had, it's no longer up. Now it's balanced to down because of the big red day. But we didn't break out of this range. So it's still in a range, but we're down. And this is how I approach everything I trade. I want to know, do the lower time frames, the 30-minute and the 1-minute, align with what I'm seeing on the higher time frames. I also pay attention to the economic calendar. I want to know when there's important news and not be involved when there is. I look at the VIX, the SMH, which is the semiconductor sector, the ETF, and the XLK, which is the sector for tech, because that's what I mainly trade. Um, and what I'm focusing on during the day is trade location. And what I mean by that is, if you can see on this image, I drew out uh, levels here 0 to 100, like almost like a Fibonacci, and you have the quarter, 75, and the 50. When I say trade location, I mean the physical location on the daily chart. Are we trading down here in what's called deep discount, or are we up here in deep premium? And that's gonna not so much bias me, but let me know. Okay, if we're trading up an extreme premium, I'm probably gonna be more apt to want to go short, as opposed to if we're down here, I'd be more apt to go long. Now, that being said, conviction trumps location, which means that even though we might be up here in at deep premium, if there's conviction to the upside, I'm not going to fight it. I'm not going to say, well, we're in premium, I'm going short, and that's it. I'm going to do what the market is telling me I have to do. Which leads me to the next point of bias and lean. I try to come in every day without having a bias. I find, for me personally, it doesn't do me any good. Especially that the way the strategy is designed, you can trade it long or short, no matter what the day is really doing. So what I will have is lean, like I just went over kind of. I will have a lean saying that if we're up here, but we have conviction, I'm leaning short, but that doesn't mean I won't go long. What I do with lean is, if my lean is say short, I will size in more. I'll put on more risk to the short side, and on the long side where I'm not leaning, I would be more of a scalper and take smaller size. Okay, stock selection, um, very important. No catalyst, no stocks in play. That's vital to the strategy working. When there is a catalyst involved, there are different players involved. The stock moves differently, and the price action is very, very different. These are the four that I trade personally every day: SPY, Q, Tesla, and Nvidia. But this will work equally well on any of the Mag 7, or any large cap, with higher floats, good institutional participation. If you are the person that does, likes to scan for gappers and whatnot, and you trade the mid caps, I would be careful with this. Just from experience alone, I've never tracked it, data wise, but from experience alone, the mid caps do have a different personality than the larger caps, and this strategy doesn't work as well on the mid cap. So the best stocks for this strategy are large cap, large institutional participation, and even more specific, the Mag 7 or the markets themselves. If you're trading options, I really want an option chain that has an average daily volume of over 90 days of at least 500,000 contracts traded. And this is for liquidity purposes. I don't trade inside like Avi trades, but I will take 100 contracts sometimes on SPY or Q. So I don't want to be trading in a contract that has very little liquidity. And most brokers will have this information, and if your broker doesn't, there's a free website called marketchameleon.com. I'll put in the link later, where you can look up the 90-day average volume of all the stocks that trade in the market. Um, this is more of a personal preference. I find NASDAQ stocks trade better. NYSE stocks, sometimes they're slow to begin. There's not the volume there in the morning, and they trade different, in my opinion, from what I've seen over the past number of years. Pre-market RVOL, which is relative volume. So I don't want a stock that's in play, but I want a stock that has some volume in the pre-market. That way, I know people are looking at it. It's being traded, but it's not the flavor of the day. Okay, now we're going to get into some entry criteria. I've broken this down the way we do in P Capital here: indicators versus confirmations. Of the indicators, I want to see 4 or 5. It seems like a lot, but when you're actually trading this and you're kind of processing all the information at the same time, it really isn't that much. You kind of just see boom, 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 boom. Okay, this is what I want to see. Now I'm interested. Divergence is a very important part of this strategy, and it's very important for anyone that trades, really, which I'm going to get to on the upcoming slides. If there's a divergence present, then 2 or 3 of these, along with that divergence, is sufficient. And many times, to be quite honest, the divergence by itself is enough to take the trade. However, I want at least something else along with that divergence. So something like price trading at the negative second standard deviation. And what that is, if you're familiar with the VWAP, they have the bands that go above and below it. I want price at that second band below it, which means it's extended. That's how I measure extension away um, from the midpoint. For those of you that use CVD, that's cumulative volume delta. I wanted to show me or suggest that there's absorption going on, that traders are buying lows and getting trapped, or that there's just a general lack of aggression on the sell side when I want to go long, or vice versa. Liquidity laddered in. This is on the book map or level 2. A vertical volume spike as price approaches the level. An entry side liquidity sweep. We all know what those look like. A low is formed, price makes a fake move higher, and then out of nowhere, it just gets swept right out. I do want to see resting liquidity at the opposing pivots, which is what usually I target. Buy, sell candle formations, wiki like hammers and kangaroo candles, like Avi talks about, at the extreme that I'm trading. I want to see wiki lows if I'm long and wiki highs if I'm going short. The trade being in the general direction of the higher time frame. And does the trade allow for minimum 2 to 1? And I'm going to be honest, I take a lot of 1.5 to 1s because of my personality and my style. But you really want to see if a 2 to 1 is possible when you're assessing the possibility of a trade. 9:30 to 10:30 is the best time to trade this. There are opportunities in what I call power hour, which is like 2:30 to 4. But the best reversals come in the first hour, and more specifically before 10:10. Now, here are your confirmations. These are what must be present in order to take the trade. A sufficient harmonic rotation. And what that is a fancy way of saying a leg. So if, stocks ebb and flow like this, right? A harmonic rotation is, what is the distance from here to here on a 1-minute chart? What's the distance from here to here, from here to here? So it's the distance of every leg. What's the average distance of the leg? And what that tells me is, if the stock is coming from here, has it traveled far enough where I should expect it to turn up? If it's only come this far, I'm not going to expect a reversal here. Even though it may go this far, print a hammer, I'm not interested because it hasn't rotated far enough based on the average rotation. That's what a harmonic rotation is.
Excuse me, Ant-Man.
Yes.
We don't see you drawing.
You
No,
don't see
I'm
it.
sorry.
All right. Okay.
To see the drawing, you cannot share the table. You have to share the entire screen, and I'm not sure where you're.
Okay.
That's why.
Okay. I did not know that, so I can switch it to the entire screen then, so we can see the drawings. That might be a good idea. Sorry about this, guys. Like I said, I'm not a tech guy, and I've never used this before.
Shane, can you help him navigate through?
Yeah. How would I get my Epic Pen to show on here?
Shane?
I'm telling you, I have presented. In order to share that, in order to see the pen, you have to share the screen. So you see on the bottom of the Google Map and Meet, there's a happy face, and on the right side is the presentation mode. You click on that, and it's going to give you some options.
It says present something else.
It said, okay, so I don't want to take over your screen, but if you click on that, it's going to give you some options, whether it's going to be table or it's going to be
I see window or entire screen. Okay.
Exactly. So instead of the window, select the entire screen.
Yep, got it. Okay. All right, so you see my whole screen now.
Do you still see, Ant-Man, the question in case later?
Yeah, no, I have this
on another screen.
All right, so do you see my entire screen now?
Not yet.
No, okay.
Because you haven't selected. You select and click OK. That's why.
Okay, I got you. On your screen, select, share. Okay, yeah, now I see it. You have my whole screen here. Let me pull this back in. All right. That should work. So now you should see my my pen scribbling.
Yes.
Yes.
Okay, all right. So let's redo that. All right. So back to what a harmonic rotation is. We all know that stocks move like this. They ebb and they flow, and they have this kind of movement. On a 1 minute time frame, what a harmonic rotation is how far does it travel on average on each leg. So this leg to here, to here, to here, here, to here. Each one of these legs, the average distance between all of them over time is an average rotation on a 1 minute chart. So the way I use this is if this is where the stock is coming from, has it traveled far enough based on the average rotation where I should expect it to come back up? You know, if we're starting from here and we only go this far, even if we print a nice hammer, I'm not interested because we haven't rotated far enough. Once this comes all the way down here and there's a level here and that prints a hammer, now I'm interested. So that's what a harmonic rotation is. Consecutive same colored candles with little to no opposing colored candles, which is what is shown right here. I want to see a nice like waterfall, a nice flush. And then when there's that flush, you know, if this here, I want it flushing into the third, a multi-level confluence. I have more than one level that's going to quote unquote catch this flush. Next slide. Now I want to talk a little bit about divergences. There are three types that I look at. This of the three, this is the quote weakest type. It's when there's divergence. No, I'm sorry. This is the strongest type. When there's divergence between the Qs and the SPY. And I use a 30-minute, but you can use an hour. You can use a 4-hour. I wouldn't go lower than 30. Basically, what's going on is using the same pivot, the same time pivot. Qs make a lower low. SPY does not. That is a very important algorithmic signature in price that the Qs are not going lower, that this is just a liquidity run, and we're going to go back in the direction of the one that made the higher low. And this is, I watch this every day. I always have SPY and Q up side by side. The next type of divergence would be the same concept, only it's SPY with the equity that you're trading. So if you say we're trading Tesla, and you see Tesla make a lower low and SPY does not, that's a very good signal that Tesla is not going any lower. And the third type, which is the weakest of the three, is if you use cumulative volume delta, it's divergence between price and the CVD. As you can see here on the SPY, price breaks this level, makes a lower low, but the CVD is moving the opposite way. And what that suggests to me is that this is aggressive buying, and that there's also this selling is getting absorbed by these buyers. So this isn't going to go any lower. And the way this got dumped and bought right back up, this is a very strong bullish sign to go long. In fact, I think I did take this trade right after this first white candle formed. Okay, now the risk strategy, which is a very important part of trading, but especially to this strategy. This is what makes or breaks you, whether or not you're going to be break even, super profitable, or have a hard time with the strategy. I don't use a hard stop. I use what's called a volatility stop. It's a dynamic stop loss. It's based on a formula that I created through my own research and just experience working with the strategy. It's calculated based on the volatility of the stock for that day. So every day, the amount of risk will be different for the stock. It's a front-weighted 20 trading day rolling average, and it sets a zone. So if you see in this example here, this box numbered 1, this is my risk zone on Tesla. You really can't see in the image, but I have a program in TOS where that little orange box says RS, which is risk strategy. It's $3.84. So that's what this box represents. And it's measured from my first entry, which is this first blue level here. So as long as price stays in this risk zone, I cost average into the trade. That's one of the keys that I found to be successful in the strategy. This is not for everyone. I totally understand that. Some people say this is averaging into a loser. It is not. If your levels are picked correctly and you follow the rules, 7, 8 out of 10 times you're averaging into a winning trade. One of the key components of this, which I will go over, is you have to pay yourself something on the first push. So you get in, pushes, you pay. It comes back down, you can add back what you paid, but as soon as it pushes, you have to pay again. And you keep doing this back and forth because this is what the stocks do at these levels. It's a constant fight back and forth between the buy side and the sell side until one side wins. And the hope is that the side that you're on is the winning side. So as soon as you get confirmation, which is why I put this in orange, this is your confirmation that this is going to go long. You have this leg here made a higher high, breaking this pivot, pulled back, printed a buyer's candle right off the level. To me, this is confirmation. I would add size right here if you want, my max risk. My stop would be here on the number 3, and I'm waiting for the push back up. And on this day, this is a trade I did take on. I think this is SPY. I was able to get a little bit off on this pop. This was a news pop, and I didn't realize it, and that's my fault. I didn't realize there was news this day, and that's what this pop was. So after this last pop here, I closed the whole position out. Trade management. Okay, so as I was just explaining to you, you have to add on washes or pops if you're short, and what I call working the core. So your core is this first position that you take. So this is a long, so you're on these pops. On these pops, you're going to pay yourself, and on these washes, you're going to add. Pay. It's just a back and forth of pay. Enter, pay, enter, pay, enter, pay until the trade goes in your direction. And the way this minimizes your losses is every time I'm taking, say for just to make the example easy, one contract here at, say the option is, $2. Then I get in here, I'm going to take 3 or 4 contracts, but the option is going to be at like $1.60. So I've just brought my cost average down to somewhere in here. And then I add again here and say the option is at $1.40, and I'll take 10 contracts. You have to increase your size as the premium decreases in order for this to work. So let's just say, for example, that after I've added in here, I'm in 20 contracts, but my cost average, instead of being $2, is down here, let's say $1.50. If I have to stop out, that's gonna be that's gonna be a smaller loss than if I stopped out from way up here. What I like to do also is move my stop to break even plus 10 cents of option premium, not of the actual stock. The option premium, once I'm at a 1-to-1, then I just set it and forget it. Whatever happens to that piece, because the trade is guaranteed to be green. Continue to take partials as you normally would and leave a runner. Now, I've included here some reasons to consider exiting early. Large opposing orders, you see a shift in order book, absorption against the trade, numerous attempts to advance, in the direction, say, price keeps hitting its head on a level and it just can't go. I might exit. If I see a change in market sentiment or there's some news that just dropped, change in price action, any of these that I see happening when I'm in the trade, I'm gonna raise a yellow flag and say, you know what, I may want to exit here, and I will assess it in the moment. Profit targets. First push I have in red because that is a must. That's what you must take, that first push. And the rest are just pretty much standard profit targets, daily levels, structural pivots, imbalance zones, which, if you're not familiar, imbalance zones are just really big red and white bars that don't have overlapping price action. VWAP, moving averages, all this other stuff. I don't have time to talk about the gamma. Maybe one day, if there's enough interest, I will do slides on what gamma is and how it works, but that is something I do look at. But I don't have anything more to say on it in this presentation because I didn't prepare. I thought I'd took this part out. Some rules for the strategy. I pretty much went over all the rules as I was explaining the setups, but you want to enter on red long and you want to short on green, which seems counterintuitive, but that's taking advantage of the option premium melt and it's giving you best possible cost average. As long as price is in your risk zone, you don't stop out. You have to hold your ground and just work that trade until the market tells you that you are wrong, which is when price closes outside of that risk zone. And just for everyone's knowledge, that risk zone, it gives me about an 80% chance of not being stopped out, where traditional stops would stop you out. And that's kind of why I designed it, because I was getting sick and tired of entering a trade, placing my stop, getting stopped out, and then the trade worked. I needed to figure out a way, how do I work around this? And this risk strategy is my solution. So add on washes and pops, work the core. You can add on confirmation with a tighten stop, partial on first push. This is pretty much a reiteration of what we just went over. When triggered, the thing you must be with this strategy is discipline. You need to have top-notch discipline for this strategy. When you have to take profit, you have to take profit. When you have to stop out, you must stop out. There's no gray area with the strategy. It will mess you up. As I said earlier about the time of day, try to enter these before 10:30. There are some opportunities later in the day. The odds of continuation, and this is backed by data, between 10:30 and 1400, which is 2 p.m., the odds of reversal are way smaller. You're probably going to get continuations in those time frames. And follow the 5 trade rule or max loss, whichever comes first. Here are some trades that I took, and they're all annotated. This was on Q's on May 14th. You see, we opened. We had a nice push, which I call a fake push. Then they started really just selling off hard. Took out the stops that were at this opening low. Came down into the bunch of levels here. This is the low of the 8 a.m. Avi candle. This is a gamma level. This is pre-market low. This is a daily. So you have a bunch of what I call protection. You have one level and you're protected by a bunch of other levels. So the idea is that if price does breach this, one of these will catch it, and they're all within the standard risk box that I have here in the risk zone. So my first entry was here as the price came down. Paid myself. Second entry was here, and then I paid myself, and that was it. And this is a chart of the 515 calls that I traded, and that's my P&L up there. You can see it was a real trade in my live account. Second trade here. This was yesterday on SPY on that big wash. When the news broke, I waited for these levels and I took it long. I took the 585 calls long right here. And you can see this is the CVD. It was actually heading up. We had a big volume spike, huge harmonic rotation, multi-level. And in my opinion, this is just an opinion. I think the sell-off compared to the actual validity of the news was nonsense. So I figured at some point this is going to find buyers. And it's going to bounce. And you can see those are my approximate entries. And that's the 585 call on my P&L right there on that one. And this is one more example. This actually is a sim trade. So, but I put this here just to show how you can really just go in and out, in and out, in and out, in and out, and then actually be wrong on the trade and still make money. And that's another fringe benefit that I feel this strategy provides, is that technically on this trade, you went long, and the long was not the trade. The trade failed. If you look at this day, this kept selling. So the trade failed, but I walked away green. So that's another positive, in my opinion, on why I like to trade this strategy. And I will leave you guys with some words of wisdom. This is not a strategy for newbies, as you can probably tell by the necessity to work the core and have the confidence to hold when price looks like it's going to keep dumping. But if this does pique your interest, see how it meshes with your personality. Trade it in sim, and I would trade shares first. Don't worry about taking advantage of the option theta in the beginning. Just get the process down. Understand how the trade works. Get comfortable with it, and then make the move to options. And when you do, try to keep them below $3. You have stuff like Tesla. The options could be as much as $8, $10, $12, and that can get pretty wild when you have more than 2 contracts on. So, and for someone that's new and that doesn't have their emotions in check, it can cause a lot of losses and a lot of bad things. And the last thing I will say about it is you want to stay at the money or in the money for this strategy. you can also trade the following week's expiry. You won't get as much of a return, but you will get less volatility. And if it is Thursday and Friday, sometimes I also take the following week's expiry, because Thursday and Fridays, especially Fridays, the volatility can get real crazy. And even if the stock is going up, the pullbacks may stop you out. So that is it. This is my contact information. I'll be happy with any questions. I don't have social media. I don't have time for that nonsense. But you can reach me at any of these contact points. So thank you guys for your time. Any questions, I'll be happy to answer.